Welcome back to the Deep Dive. It's Wednesday, February 18th, 2026. Today, we're doing something a little different. We're not just looking at a balance sheet. We're basically taking a tour through the living rooms of the top 10% of the American economy.
It's a fascinating place to hang out, honestly. Much better furniture.
Better views, for sure. And apparently, much, much better financials. We're breaking down the Q1 2026 earnings from Toll Brothers. And I know homebuilder earnings might sound a little dry, but stick with us.
Yeah, this isn't about drywall.
Right. This is a direct look at the health of the wealthy American consumer.
That's it, exactly. Toll Brothers is the proxy. They call themselves America's luxury home builder. So when we look at their numbers, we're really seeing how the upper crust is navigating, high interest rates and all this economic uncertainty.
And judging by this report, they're navigating it just fine. I've got the full stack here, the transcript, press release, the slide deck. Let's start with the headline numbers because they didn't just beat expectations.
No, they kind of crushed them.
They crushed them. It was a beat across the board. Revenue, margins, earnings per share.
All of it.
The one that really jumped out at me was the earnings per share, the EPS. They came in at, what, $2.19?
Yeah, $2.19. Wall Street was looking for something like $2.05.
So pretty big beat. And compared to last year, that's a 25% jump.
Which is huge. And you have to look at how they did it. They delivered almost 1,900 homes, generating about $1.85 billion in home building revenue. Now, that revenue number beat their own guidance by $24 million, which is good. But the fact that earnings grew 25% while revenue grew slower, that tells you something really important.
It's all about efficiency.
Exactly. They're squeezing more profit out of every single dollar they bring in. But I think we need to get into how they're selling these houses because I think there's a big misconception about luxury builders.
Oh, what's that?
Well, this idea that it's all purely custom. You buy a lot, you sit down with an architect, you wait for 2 years. But looking at this report, Toll is playing a very, very different game with this whole spec versus build-to-order mix.
This is the core of their strategy right now, isn't it? This 50-50 mix.
It is. Half their business is build-to-order. That's your traditional custom dream home. And the other half is spec. So speculative homes, they start building before they even have a buyer.
Which, on its face, that sounds incredibly risky. You're building a $2 million house and just hoping someone walks in the door and wants it.
In a downturn, sure, it can be terrifying. But right now, it's their secret weapon. It lets them capture two completely different types of wealthy buyers.
Okay, so break that down for me. Who are these two buyers?
So first, you've got the planner. This is the person who wants the dream home. They want to pick out every single faucet, every tile. They're willing to wait 10 months.
That's your build-to-order customer.
That's them. And that business is incredibly high margin. Gross margins were still above 30% in Q1 for that segment.
30% gross margin is fantastic. So why not just do 100% custom then, if the margins are that good?
Because you'd totally miss the immediate gratification crowd.
Okay.
I mean, think about the corporate executive who just got transferred or the family who just sold their old house in a bidding war and they need a place now for the next school year.
They can't wait 10 months.
They can't. The spec homes serve that buyer. So the margins are a little lower on specs, but the cash turns over so much faster. It's great for cash flow. And management made this really crucial point about risk management here.
I saw that. They said the 50-50 mix basically lets them pivot on a dime.
Right. If the market suddenly tanks, they can just stop starting spec homes tomorrow. It gives them this throttle, to control their inventory risk.
So it's offense and defense at the same time. Okay, so that's the how. Let's talk about the who. Who is actually buying in these places? Because all we hear about is the affordability crisis in the U.S.
Right. Rates are up. Prices are up.
First-time buyers are completely locked out. But Toll Brothers seems to be operating in, like, a parallel universe.
They are completely insulated from that narrative. Their customer base is what they call the luxury move up and the luxury move down.
And move down is basically the empty nesters cashing out.
Precisely. Boomers selling the big family estate for a fortune and moving into a high-end but lower maintenance luxury home.
And the move up is the millennial professional family finally getting their forever home.
Exactly. The common denominator for both is equity and cash.
Okay, the cash, I had to double check this stat because it just seemed wild. 24% of Toll buyers paid all cash in Q1.
1 in 4.
1 in 4 buyers. No mortgage, no sensitivity to interest rates, just writing a check.
It's staggering. And even for the ones who do get mortgages, they're not exactly scraping by. The loan-to-value ratio is only 70%.
So wait, that means the average borrower is putting down 30% in cash?
A 30% down payment. So even if rates are at 6 or 7%, their actual monthly payment is manageable because the loan is just so much smaller relative to the asset.
It just highlights this massive split in the economy. And then they spend a fortune to decorate it. We have to talk about the design studio numbers.
Oh, this was my favorite part of the report. This is the stickiness factor.
It's incredible. So on average, in Q1, a Toll Brothers buyer spent an extra $212,000 just on upgrades.
Let's just pause on that. $212,000.
I mean, that is the price of an entire starter home in some parts of the country.
Yeah.
And they're spending that just on, what, nicer cabinets?
Flooring, lighting, structural options like adding a sunroom or a grander staircase. It adds about 25% to the base price of the home.
But here's why I think this matters more than just the revenue. It's the psychology of it. If I spend 20 hours in a design studio picking out 200 grand worth of custom finishes, I am so emotionally committed to that house, I am not walking away from that contract.
You're absolutely right. It creates massive backlog stickiness. When you customize a home to that level, it becomes yours long before it's even built. It explains why their cancellation rates stay so low even when the headlines get scary.
So we know the who and the how.
Yeah.
Let's talk about the where. Because real estate is always local, and it sounds like the map has shifted a bit.
It has. There's a really distinct winner category right now. Management kept highlighting the Boston to South Carolina corridor.
Which is interesting, because usually we think of the Northeast and the South as separate markets. They're treating the whole Atlantic coast as one big boom belt.
And it's performing exceptionally well. But it's not just the East Coast. The mountain region, Boise, Vegas, Reno, that's back. Those markets cooled off really fast after the pandemic boom, but they've roared back.
In California.
Always California, still a heavyweight champ for them. They mentioned one community at the Great Park in Southern California where they had 23 sales.
23. And these are not cheap homes.
Not at all. Ranging from $1.5 million to $3 million.
Just casually moving inventory at $3 million. But it wasn't all sunshine. They did call out some soft spots. Tampa, Atlanta, San Antonio, and the Pacific Northwest.
Yeah, Tampa and Atlanta were a bit surprising given how hot they've been. But management seems to think it's just a period of digestion after massive growth.
They did pull out the classic weather excuse for the South, though.
I know. It rained, so we didn't sell houses. Investors usually roll their eyes at that.
I usually do, too. But the CEO, Doug Yearley, he actually got really specific. He mentioned the ice and snow that hit the Carolinas and Atlanta.
And specifically noted trees down at Vanderbilt University.
Right. Which adds this little bit of credibility. If the CEO is referencing specific university landscaping disasters, it was probably disruptive enough to shut down job sites for a week or two. So maybe that softness is temporary.
The weakness in the Pacific Northwest, though, that seemed more structural. They brought up foreign buyer sentiment.
Yeah, this was a subtle but really important point. They linked the softness in places like Seattle and Portland to uncertainty around visa status, specifically H-1B visas.
That makes a ton of sense for those markets. If you're a tech worker on a visa and you don't know if the government is going to let you stay, you are not buying a $1.5 million house.
Not a chance. It just shows how interconnected housing is with, geopolitical and immigration policy.
Totally.
Speaking of the future, there was a major corporate shift announced on the call. Doug Yearley is stepping aside as CEO.
He is. He's moving to executive chairman. And Karl Mistry, who runs their Eastern operations, is going to take over as CEO on March 30th.
And get this, he's only the third CEO in the company's entire history since 1967.
That is remarkable stability for a public company, and Mistry has been there for over 20 years.
So we shouldn't expect any, radical strategic pivots.
I highly doubt it. This just signals steady as she goes. But speaking of strategy, we kind of glossed over a huge move they made this quarter.
Oh, the divestiture.
The divestiture of their apartment living business. Yeah. They sold half the portfolio to Kennedy Wilson for about $330 million in net cash.
So why do that now? They're getting out of the rental game.
It's a move to become a pure-play home builder. It simplifies the story for Wall Street.
And it gives them a war chest.
A massive war chest. $330 million in cash is a lot of dry powder. They can use that to buy up land while competitors are being cautious, or they can buy back stock. It's a really smart capital allocation move.
Okay, I want to get to the part of the call that actually made me laugh out loud. because usually these calls are so scripted. But Doug Yearley went off on this little tangent about construction technology.
The Boots story.
Booth's story. He talked about how 35 years ago, the founder, Bob Toll, sent him out to buy a pair of Timberland boots and get in a construction trailer.
And his point was profound in its simplicity.
Yeah.
The way they build houses today is basically identical to how they did it when he bought those boots.
It's kind of wild when you think about it. I mean, we have AI, we have reusable rockets, but we're still framing houses with guys holding hammers and saws.
He even referenced a question about Japanese modular construction, which is way more advanced, and he basically said, yeah, we're watching it, but it's not really here yet.
Is that a risk, though, being so low-tech?
Short term, clearly not. It's working for them. But long term, it's the biggest unanswered question in the entire industry. I mean, productivity in construction has been flat for decades while every other industry has skyrocketed. Eventually, that bill comes due, but for now, Toll is winning by mastering the old way.
Right, so looking ahead, it's mid-February. The spring selling season is upon us. What's the outlook?
The buzzword they used was cautious optimism.
Which is CEO speak for business is good, but I don't want to jinx it.
Pretty much. Since mid-January, they've seen traffic, both web and foot traffic, start to tick up. Deposits are up. The spring season has officially started.
And they back that up with the pricing data, which I thought was key.
This is a huge lead indicator. The average price of signed contracts in Q1 was $1.033 million.
Okay, so that's up 6% from the previous quarter.
Yeah.
But distinguish that from the delivered price.
Right, so the delivered price, the homes that actually closed in Q1, was $977,000. But those are deals that were signed 9 or 12 months ago.
So the new contracts are coming in at a higher price.
Exactly. It tells you that pricing power is accelerating right now, not decelerating.
That's bullish. And what about incentives? Are they still having to give stuff away to move these houses?
Nope. Incentives stayed flat at about 8% of the sales price. This is the third quarter in a row at that level.
That feels really significant. If demand was getting soft, that number would be creeping up to 10 or 12%.
It would. Flat incentives with rising prices means you've got real demand. They aren't just buying the sales.
I did see a note about margins dipping slightly in Q2, though. Is that a red flag?
I don't think so. They guided full-year gross margins to stay at 26%, which is very healthy. They did say Q2 would dip a little to 25.5%, but they attributed it entirely to mix.
And mix just means where the houses are located, right? Fewer from California.
Correct. California has their highest margins. They just happen to have fewer homes finishing there in Q2, but then more in Q3 and Q4. So the margins should U-turn right back up in the second half of the year.
So bringing this all home, we've got a company that beat earnings, they're raising prices, they're sitting on a huge pile of cash, and they're seeing customer traffic increase.
It's a classic beat and raise story, and honestly, it's a testament to the resilience of the American luxury consumer.
It really is. It counters so much of the doom and gloom narrative. If you only read the headlines, you'd think the entire housing market was frozen solid. But Toll Brothers is proving that if you have the right product, the buyers are absolutely there.
And that's the macro takeaway for you, the listener. Even if you aren't buying a $3 million home, this report matters because it highlights the chronic housing shortage in the U.S. Yearly mentioned we need anywhere from 3 to 7 million additional homes just to reach equilibrium.
That is a massive, massive hole to dig out of.
It is. And as long as that shortage exists, builders like Toll have a real floor under them. Supply is constrained, demand is pent up. That is a recipe for long-term strength.
It's a fascinating look at the very top of the market. But I want to leave everyone with one final thought, something to chew on based on that Boots story.
Okay, let's hear it.
So, Toll Brothers is making money hand over fist, doing things the old-fashioned way, hammers, nails, patience. But we have a 7 million home shortage.
Right.
Can we ever actually solve a shortage that big using 35-year-old methods? Toll is betting on the status quo, and they are winning big today. But will the next massive boom in housing come from interest rates just dropping? Or will it finally come from technology, from someone figuring out how to build these things faster and cheaper?
That is the trillion-dollar question, because eventually just adding more guys in work boots might not be enough to fill that gap.
Exactly. Toll is winning the game as it's played now, but I just wonder if the rules themselves are about to change.
Something to think about.
That's all for this deep dive into Toll Brothers Q1 2026 earnings. Thanks for listening, and we'll catch you on the next one.